Hello and welcome to a special edition of Auto News Now. I'm Jeremy Carroll. I'm joined today with Erin Kerrigan from Kerrigan Advisors. How are you?
I'm good, Jeremy. Thank you so much for having me.
Yeah, we're glad to have you and welcome back to an in-person event. It's exciting to be seeing all these people, isn't it?
It is amazing to be back in person and maskless. It's just wonderful to see everyone's faces and smiles, and obviously it's a very good time in the industry, so people are having a very good time at NADA.
Yeah, very good. Well, let's dive into the buy-sell market. So last year, 2021 was the year of the Megadeal, where these big public dealerships were buying big dealership groups, right? What's 2022 looking like? How's the first quarter started?
So we do believe 2022 is a continuation of 21's Megadeal trend. We expect you're going to see a lot more significant transactions announced, and the buy-sell activity will be consistent this year with last year, which is pretty incredible because last year was incredible. We saw nearly a doubling of activity level as compared to pre-COVID levels. And we don't see anything stopping that. So with interest rates still low, with the tremendous profitability in the industry that has continued unabated in the first 2 months of this year, we expect dealers will continue to reallocate their earnings back into the industry that they know well and love, and expect that it will continue as we see profitability remain so high.
Wow, yeah. And so what is driving this? Is it just that as the dealers are now flush with cash and so they're looking to expand?
The primary driver of the industry, no question, in terms of buy-sell activity is profitability. To give you a sense, dealership profitability on average is up 185% as compared to pre-COVID levels. And at this juncture, there's nothing on the horizon that would stop that from continuing in terms of the high levels of earnings that dealers are experiencing. So for many, they really do literally have a cash problem. They have mounds of cash, and they do want to invest that capital. And keep in mind that auto dealerships right now have the highest return on equity of really any investment they could make. So many are reallocating those funds into acquisitions. And the reason being in part is also that today, many dealers feel scale is a key differentiator for their success. And the idea of being a smaller dealer is much less attractive than it used to be. It used to be, you could have one or two dealerships. Today we see a contraction in the number of groups with 5 or fewer dealerships. And since 2010, the number of dealership groups with 11 or more dealerships has more than doubled. And we expect that will continue to be the case because COVID really pointed out that even though everyone did well post-quarantine, the groups with the most size and scale truly outperformed coming into 21, and we're seeing that scale is an increasingly important part of success.
So is this the end of the mom and pop dealership, or is it just shrinking?
I would never say it was the end of the mom and pop dealership and dealership group. I think that families, though, are coming to some important decision points. And if you think about it, the industry has defied the statistics in terms of generational transfer. So 30% of family businesses typically make it to the second generation, 12 to the third, and just 3% to the fourth. Auto retail, we have I'd say half the industry is in the second or third generation. So we have very much defied those odds. What we're seeing is that as these enterprises become so valuable, and they are now owned by multiple family members, some are saying, gosh, at these valuations, maybe it makes sense for us to take some chips off the table. Now, the other thing that's driving dealers to market is just all of the plethora of announcements about the potential changes to the model by the OEMs. It seems like the last few weeks in particular, we've gotten a lot from the domestics. And that has caused more dealers to give our firm a call and say, you know, I never thought I'd do this, but I'm actually considering a sale because I don't want to pass down a different business to my kids than I've had the benefit of running, and my father or mother had the benefit of running. So we have seen an increase in sellers considering a sale more immediately because of some of the announcements.
Yeah, so specifically we're talking about electric vehicles, right?
Electric vehicles, direct-to-consumer, agency model, all those things.
So how is electric vehicles themselves impacting the valuations of dealerships?
So electric vehicles, interestingly, despite the fact that the OEMs seem to be in a rush to see who can spend more on this new technology, electric vehicles in and of themselves, quite interesting to us, are not impacting blue sky values. And we really chalk that up to two reasons. That buyers aren't saying, okay, you know, now with electric vehicles coming out, we're going to change the valuation. The first reason is we think most buyers do not anticipate electric vehicles coming to market as quickly as everyone is saying. So the market doesn't expect it as quickly as maybe some of these announcements that are being made. And the second is no one really has a clear understanding as to how electric vehicles will impact the dealership business model. So that the buyers can't project either way where profits are going to head, and so they really aren't factoring it in. And we think that's pretty interesting because it's quite divergent from all of the publicity that electric vehicles currently are receiving.
Yeah, very good. Well, Erin Kerrigan, thank you so much for joining us.
Thank you so much, Jeremy. Thank you so much, Automotive News, for having me on this program.
Yeah, we'll see you back here later. Thanks so much for watching.